Welcome to this explainer. Today, we're diving straight into the real mathematical mechanics behind dividend investing versus index funds to reveal the true engine of long-term wealth creation. If you've ever felt that absolute rush of a dividend check hitting your account, or, on the flip side, if you've ever stared at a boring index fund balance and wondered if you're somehow missing out on the whole passive income craze, well, you are exactly in the right place.
So, let's just get right into it. Is your passive income actually costing you a fortune? We really need to talk about the massive gap between what you think passive income earns you and what it's actually costing you in taxes, lost growth, and opportunities you probably never even saw. Because when you sit down and run the real math on dividend investing, the results might just force you to rethink absolutely everything you've been told. To keep things perfectly fair, let's look at two completely identical investors. We've got Jake and Marcus. They're both 30 years old, they both earn $75,000 a year, live in the same city, and they both invest exactly $1,000 a month in a regular taxable brokerage account for 30 years. But their strategies are day and night. Jake builds a dividend stock portfolio. He's buying heavy hitters like Coca-Cola and J&J, plus high-yield ETFs like SCHD and JPI, pulling in an average yield of about 4%. Marcus, on the other hand, does something embarrassingly simple. He just buys Vanguard's S&P 500 index fund, VOO. He doesn't track yields at all, he just buys the broad market and walks away. Fast forward 5 years. Jake is absolutely loving his strategy. His portfolio is throwing off close to $2,800 a year in dividends. Every quarter, real, tangible cash hits his account. He's got great stories to tell his friends at barbecues about the passive income he's generating. Meanwhile, Marx's VOO position has grown to roughly $73,000, but nothing actually arrives in his checking account. No checks, no push notifications, just a number quietly going up on a screen. Jake has stories, right? Marcus just has a balance. And on every visible scoreboard, Jake feels like a strategic genius. Okay, here's the core mirage that Jake is falling for. It's a fundamental concept called dividend irrelevance. When a company pays a dividend, that money doesn't just magically appear out of thin air. On the ex-dividend date, the share price drops by exactly the amount of the dividend paid, period. If a $100 stock pays a $2 dividend, it opens the next morning at $98. Transferring that $2 from the share price into your cash account isn't creating new wealth. It's literally just moving columns and triggering an immediate tax event. It's essentially a forced partial sale of your own position. And, I want to be super clear here. This idea that dividends don't inherently create new value, it's not just some spicy YouTube hot take. Wall Street has recognized this mathematical reality since economist Miller and Modigliani published it over 60 years ago, way back in 1961. The problem is, your favorite passive income influencer probably just forgot to mention it. So the real kicker is that dividend investors often take on hidden risks they never even signed up for. Chasing yields is a massive one. High yields very often signal underlying distress. People chased AT&T and Wells Fargo right before massive cuts, or General Electric, which literally slashed its dividend to a single penny. You don't just lose the income, you lose capital when the share price inevitably crashes. Furthermore, dividend portfolios systematically underweight the technology sector, meaning you miss out on the very engine that has driven the vast majority of U.S. market returns over the last 20 years. But honestly, the most dangerous part? It's the behavioral trap. That constant cash flow from dividends acts like a psychological smokescreen, totally hiding the actual portfolio underperformance from the investor. Now, to be completely impartial, we have to look at the other side of the coin. Marcus's index fund strategy. It is not perfect, and it can be a really bumpy, uncomfortable ride. With broad index funds, you get zero psychological comfort from an income stream. Marcus actually has to log in and actively sell shares to get cash. Also, the broad market is highly concentrated right now. Mega-cap tech stocks like Apple, Microsoft, and Nvidia make up a massive chunk of the index. Finally, index funds lack built-in emotional discipline. Without those reassuring dividend checks arriving to soothe your nerves, you are way more susceptible to panic selling during a brutal drawdown, like that terrifying 34% market crash we all lived through in March 2020.
And this brings us to why Jake eventually falls so far behind. It really boils down to three distinct compounding leaks. First, there's a roughly 1% annual return drag, simply because dividend strategies historically return about 9% compared to the S&P 500's 10%. Then you have the annual tax drag. Every single year, the IRS takes a bite out of Jake's dividends. Some at capital gains rates, sure, but some at ordinary income rates all the way up to 37% for his REITs and high-yield ETFs. That is money siphoned right out of his compounding engine. And finally, there's the expense ratio gap. Jake is paying anywhere between 0.06% and 0.35% in management fees for his ETFs, while Marcus pays practically nothing, just 0.03% for VOO.
Let's look at how this builds over the long haul, because these leagues are running simultaneously for 360 months straight. At year 5, the gap is basically invisible, but by year 10, a $20,000 wealth gap has opened up. By year 15, it's $55,000. By year 20, Marcus is pulling ahead by $110,000. And Jake literally never sees this happening because he's only comparing his portfolio to last year's version of himself. His dividend checks are getting slightly bigger, so he feels like he's totally crushing it. But then we hit year 30, age 60, retirement day, and that final gap between our two identical investors, it's a staggering $370,000. That is literally the cost of a fully paid-off house that Jake just left on the table. And the craziest part of it all, he never even knew he lost it because his account balance technically kept going up. When the dust finally settles on year 30, Jake actually ends up with a very respectable $1.41 million. But Marcus, by using a mathematically optimized, totally boring, tax-efficient approach, yields $1.78 million for the exact same $1,000 monthly contribution.
So where did all that money go? Well, this massive $370,000 shortfall is heavily driven by the tax drag over those 3 decades. Jake was forced to hand approximately $48,000 over to the IRS over 30 years as his dividends were taxed year after year. Marcus, meanwhile, legally sheltered his compounding engine by holding his index fund, generating minimal taxable distributions. He paid only about $3,000 in taxes. That is a $45,000 swing in capital that Marcus got to keep compounding and Jake just lost forever.
And you know, the gap doesn't even stop at accumulation. It extends all the way into estate planning. If Marcus passes his index fund portfolio down to his kids, a tax rule called the step-up in basis legally resets the cost of his shares to their value on the exact date of his death. It wipes away decades of capital gains taxes entirely. His heirs can sell and owe 0 federal capital gains. Jake's portfolio, on the other hand, was already taxed every single year of its life. He paid his taxes along the way, and there is simply no equivalent recovery for his heirs. But wait, right? Isn't retirement the exact phase where dividend stocks are supposed to shine? Well, let's check the math on that. Both guys are now 65 and they need $50,000 a year to live. Jake's portfolio throws off $56,000 in dividends, so he doesn't have to sell a single share. Sounds great, but he owes taxes on every dollar, resulting in a $6,000 to $8,000 federal tax bill. Marcus, however, sells $50,000 worth of shares. Because most of that is long-term capital gains, and because single filers pay literally 0% on long-term gains up to about $48,000, Marcus has total control over his realized gains. His federal tax bill on a $50,000 withdrawal is close to 0. So Marcus pays practically nothing in taxes, takes home exactly what he needs, and still has a $370,000 principal advantage quietly compounding in the background.
Now, before you go and completely abandon dividend stocks, it is absolutely vital we talk about where they genuinely make sense, because they certainly do have utility. First off, if you place them inside a tax-advantaged account like a Roth IRA or a 401k, that massive annual tax drag disappears entirely. Second, behavioral advantages are very, very real. If the psychological comfort of quarterly cash flow prevents you from panic selling during a market crash, then that emotional edge easily outweighs the mathematical disadvantage. The best strategy is always the one you actually stick with. And finally, dividend aristocrats can be highly effective as a complement to your core portfolio for stability, just not as a total replacement for total market growth.
So to put all of this into action, you can follow this simple, data-driven playbook. Step 1. Accumulate your core wealth in low-cost index funds like VOO or VTI in your taxable accounts. This is where the math simply wins on taxes, fees, and broad diversification. Step 2. If you really want that dividend exposure, hold it strictly inside a Roth IRA to protect it from the IRS tax drag. And step 3, as you get within 5 to 10 years of actually retiring, you can begin shifting a portion of your portfolio to dividend growth stocks for income stability, smoothly adjusting your cash flow structure for that specific stage of your life.
Ultimately, the real trap isn't dividend stocks themselves. The trap is being told that passive income is the goal, when total return is the actual finish line. Dividends were never free money. It's literally your own share value being handed back to you with a tax bill attached. So as you look at your own portfolio and plan for the decades ahead, I want to leave you with this question to ponder. Are you chasing the comforting illusion of passive income, or are you building the mathematical reality of